loans are concerned. So when we say public service loan forgiveness is by far the best option the Department of Education has for repayment. It's just never worked very well. But in conjunction with other things like the account adjustment and the SAVE plan, it's begun to. So with public service loan forgiveness, it's essentially the Department of Education making a deal with the borrowers. You have to make 120 qualifying payments. A qualifying payment is a payment made while working for a qualified employer at least 30 hours a week, while in a qualifying plan, which would make the payments you make qualified payments if they're full and on-time payments. At the end of that payment period, or those 120 payments, everything that's left, it doesn't matter if it's $10,000, $10,000, or $100,000, will be forgiven tax-free. So when your student loans first go into repayment, everyone gets a bill in the mail. That bill is just a standard repayment. Your average borrower will think that's the plan they have to pay their student loans under, when in fact, for public service loan forgiveness, more specifically, that is not a qualifying plan. You'll not only on average will you pay far less in an income-driven repayment plan because they're based on what the IRS calls your discretionary income. This will be important when we speak about the SAVE plan. They take what the borrower makes in a year plus their family size, the difference between that and 150% of the poverty line. They divide it by 12. The income-driven repayment plans, this one in particular, is 10% of discretionary income. They range from between 10 and 20%. You can see the difference in the monthly payments when you're in an actual qualifying plan, an income-driven repayment plan, and when you aren't. It isn't just the monthly payment, but also that possibility of forgiveness at the end of your repayment period. That's really the difference between having student loans for the entirety of your life, which a lot of people before these programs thought that they would, and having an affordable payment and being able to pay that loan off.
Aaron, I know it's often asked of you what the tax ramifications are of that forgiveness amount.
So with general student loan forgiveness, Congress has passed a moratorium on taxes. They've passed it over the course of the last decade or so. It expires in 2025, but neither party has a problem with it. It'll continue. Public service loan forgiveness has never been taxable on a federal level, ever. There's only 6 states that tax forgiveness as income. Those 6 states that brought the lawsuit, they got the Biden-Harris forgiveness thrown out. But public service loan forgiveness is not taxable. So, excuse me, when we say student loan forgiveness, specifically public service loan forgiveness was created in 2007. It had no real infrastructure until around 2010. Legally, the Department of Education couldn't begin forgiving loans until 2017. However, 98% of people that actually qualify for it never get it. I started this off by saying public service loan forgiveness is by far the best option for repayment for people that qualify for it. I hold to that, but the program traditionally has never worked very well. One of the biggest issues that borrowers have is their servicer. Your servicer is the person to whom you make your payment to. Something that was said in open court, as a matter of fact, is that the servicers lose money when student loans are forgiven. So it isn't always in their best interest to be as helpful as they should with that process. A lot of times we'll see a service like, for example, we have a client who works for St. Elizabeth Hospital here in Ohio. She's worked there for over 20 years. Herself as the borrower has qualified for the program the entire time it's been in existence. Her servicer has continually told her, well, you don't qualify for public service loan forgiveness, which was only half the story. She herself as the borrower qualified, her loans did not. Public service loan forgiveness dictates you make your payments under an income-driven repayment plan, which was a very simple fix. The servicers just have no incentive to give that information. Servicer issues loan program issues. What I mean by loan program issues, there are different types of student loan programs. There are Parent Plus loans. There are FIFO loans, which is the old student loan program for most people prior to 2010. There are Perkins loans you get from your state that are through your college. None of these loans on their own qualify for public service loan forgiveness. What the servicers don't tell people is they can be made to qualify. One of the issue that's becoming more and more of a problem that isn't talked about much, to enroll in public service loan forgiveness, you have to certify your employment. There's an employment certification form. Part of that form, the person that signs it has their contact information, their email address, and their name. Because of most of what the federal government does is electronic, if that part of the form isn't legible, the computer can't read it, for instance, the person may have written in cursive or maybe like myself and have really bad handwriting. That's something else that would trigger an automatic decline, so to speak. They won't even look at it, but they don't inform the borrower of this. They are just never enrolled in a public service loan forgiveness. There's a communication breakdown when that happens. That's becoming more and more of an issue, as well as repayment plan issues. While the information is readily available, you have to be in an income-driven repayment plan. You'll notice that the servicers never tell people that technically income-driven repayment plans, they're for 12 months at a time. They have to be recertified every year. There was someone who every single year, she tried to recertify, every month she made her monthly payments. She thought she was in the correct plan and program. Her servicer never told her this plan needed to be recertified. And the past 7 years, she actually was not in that plan. Even us who do this every day, they give us a really hard time making sure people are actually enrolled into the program. So beginning in 2021, the Department of Education began programs to nullify these mistakes or to correct these mistakes with public service loan forgiveness. One of the biggest and best programs they've ever done, I have to be honest, when it was announced and we were reading it, I couldn't even believe it, is the account adjustment. So the account adjustment took the benefits of the temporary public service loan forgiveness waiver and expanded on those benefits. When we say account adjustment, the accounts that are being adjusted are income-driven repayment plans.